Good afternoon, and thank you for attending the Morris Financial Concepts second quarter 2015 quarterly market review. This is Mario Nardone of East Bay Financial Services, and as you know, I work very closely with our friends at Morris Financial Concepts on investment-related decisions, analysis, and communications. So again, thank you for listening into the webinar today. Feel free to email any one of the MFC team with any questions you might have stemming from this recorded webinar, and if necessary, they will be happy to forward them on to me or respond to you directly. The purpose of today's call is to mostly educate and inform each other and you about the market environment and how it impacts our strategies, our client portfolios, and our decision making. So as you listen into these calls quarter after quarter, you'll hear some of the recurring themes. And the whole point is that while it does explain why your accounts may be performing the way they are, I think if nothing else, you'll hear why we do things the way we do. So on the first slide, you'll see the left side of the page gives you that age-old disclaimer in the investment industry that, this is a hypothetical review. This usually goes along with a disclaimer that says past performance is not indicative of or a promise of future returns. But also we have to recognize that when I discuss strategies and how portfolios may be performing in this environment, we have to recognize that no individual investor or client has this exact strategy or has the same strategy. If they do, then it's purely by coincidence, because we know that the way Morris Financial Concepts manages money is very customized to each individual client's risk tolerances, their constraints, their tax implications or sensitivity, and that sort of thing. So the conversation today is really a more general conversation, but if you have specific questions about your own experience and how it pertains to any of the factors we discussed today, please feel free to let us know. So on the right side is an overview of the various slides that we will be going over today in various levels of detail. The market summary slide takes major asset classes from around the world and just gives you a brief overview of how they performed in the second quarter. Now, we know that since the second quarter ended a few weeks ago, there have been a lot of changes. And again, we're not trying to give up-to-the-minute information here. This is not really meant to be something of a portfolio assessment. But it is really to look at a period of time that we have had time to digest and look at as an overlay to our strategies. So if you want a more up-to-date analysis, again, feel free to give us a call. So what you'll see here in equity markets, also known as stocks, U.S. stock market, international developed markets, so these are countries you're mostly familiar with from an industrialized world perspective, like Germany, Italy, Australia, and Canada. And then emerging markets, most familiar country names there are the BRICS. Your Brazil, Russia, India, and China constitute some of the emerging markets. Across the board in the second quarter, we saw pretty modest positive returns. So if you think about the long-term expected rate of return from stocks being somewhere around 8 to 10%, these quarterly figures were somewhat small. Now, if we look at global real estate, and what we're talking about here isn't really residential real estate as we think it, but what we're talking about are real estate investment trusts. So these are securities that hold commercial real estate but trade like stocks and make commercial real estate investing much more accessible to folks like us so that we don't have to go out and spend $1 billion to buy an office building. Because of the potential and threat of slowing Chinese growth and other slowdowns and impacts in the market, we saw global real estate slide quite precipitously in the second quarter to the tune of about 8%. But what we have to remember is that that's coming off of a really long stretch of success. And later on, we'll talk about another factor contributing to that, and that being the rising interest rate environment and the expectation of higher yields in bonds down the road. I'll make that connection when we talk about REITs in detail. But for now, the only other point to make about bond yields, as we know, when bond yields go up, bond prices come down, and that's exactly what happened in the second quarter. So we saw bond prices actually falling here in the U.S. by about 1.7% and globally by about 3.2%. The world stock market performance slide shows you the path that global stocks took from the beginning of the period, which is April 1st, through the 3 months in the second quarter to the end point on June 30th. And while there was some volatility in between, the overall trend was slightly positive for the first half of the quarter and then kind of coming back down to earth. And what you see here in the text above the line are all of those headlines throughout the quarter that can be considered positive news that may have had some influence over increasing stock prices. But then those headlines that were somewhat negative, you see below the line, which may have had the effect of dragging stock prices down. You know, some of the big points I mentioned it already. China hitting slowest growth in the last 5 or 6 years. But then on the plus side, U.S. stock markets were hitting new highs, and that tends to have a self-fulfilling type of result. People see things doing well, they want to get in on it. It tends to have a little bit of a momentum effect. That is, until it doesn't. And sometimes all that takes to turn around is another bit of negative news. So we had the result came out that the U.S. economy actually shrunk by almost 1% in the first quarter. The timing of this presentation can't be better because we just found out that now in the second quarter, the U.S. economy came out with some of its strongest growth in recent periods. Now, one thing you keep hearing again and again from us is that we don't try to predict how the economy is going to go, how the stock market is going to go, and in fact, in the long run, statistics show that there is no strong correlation between the stock market and the economy, yet financial media like to always draw that conclusion. But nonetheless, it does play into consumer sentiment and especially investor sentiment. So just one thing to consider there. The world asset class slide really just lines up various types of investments, mostly individual categories within stocks, from best performing at the top of the page to worst performing at the bottom of the page. So the only one I really wanted to call out towards the top is the second one here that says MSCI World ex-US Small Cap Index. What that really means is foreign stocks outside the United States that are small companies. And the reason why I call that out is because that is one part of the market that the MFC strategy likes to overweight or target in its portfolios. So that was a bright spot in the second quarter. You see it was one of only 2 categories that returned over 2%, and it was actually double that, over 4%. Let's take a little bit of a deeper dive into U.S. stock performance over the period. So I just mentioned international small cap companies, but now we're looking specifically at domestic or U.S.-based smaller companies. And you still see that small cap companies are at the top of the page, specifically driven by small cap growth. Now that's not a category we specifically target, although we do have some companies within the mutual funds we own that could be considered small cap growth. So that was a strong point. The exact opposite being small cap value. But again, they're parts of the portfolio. They're not really significant weightings, but they are nonetheless elements that you'll see on your statements or in conversation with us. If you look at the bottom of the page, you see that what you may have been noticing in your account statements over the last 3 or 5 years is that we've actually had very strong returns from domestic stocks. I mean, we came off of pretty bad periods, but now for 3 or 5 years in a row, we're talking about annualized returns in the high teens. So that's quite substantial growth. Over the 10-year periods, we see returns in the more normal range across the board. As I said earlier, typically we expect stock returns to be between 8 and 10%. Turning away from the United States now, we're looking at international developed stocks. Now, I actually don't like the label of that slide. It should say developed markets stocks, again, meaning those industrialized nations that have well-regulated and transparent stock markets and things like that, such as Germany, Italy, mainstream countries. Also, developed markets tend to mean that they have an established banking industry, established currency policies, and things like that. So looking at these stocks, the one thing you want to understand is how to read this chart. And what we have to remember is that if you're going to buy a stock in a foreign country, if you wanted to actually go through that mechanism, you would have to trade in your dollar for whatever currency that stock trades in and buy the stock in its home currency. And in order to calculate your rate of return over that period, you have to hypothesize or assume that you then sell the stock, get the currency it trades in, and convert it back to dollars. So what this chart does is it shows you what the rate of return would have been for investors in the home currency of the stock, and that's the dark shaded bar here, for example, where my cursor is on small cap. You see that if you had invested in each of the companies in this index in its home currency, your rate of return would have been 2.14%. But in a reversal from previous periods, and again, if you listen to the webinars, you would know that in past periods, the dollar had been strengthening, and that was bad for U.S. investors in foreign countries. In this case, over the second quarter, the U.S. dollar actually weakened versus foreign currencies, and that means that our rate of return in the exact same companies was double that was experienced by investors in their home country. Now that seems counterintuitive. Our currency weakened, so we did better. And that's because over this period, the assumption is we didn't hold our currency. We held something that was denominated in a foreign currency. So we get helped when we're not in the currency that underperformed. I hope that makes sense. Feel free to email or call if you need a further explanation. But again, in international stocks over longer periods of time, we're starting to see more normal rates of return. Over the 3 and 5 year period, very strong, but the period before that was quite weak for international. So 10-year numbers are still kind of lackluster in the 4 to 6% range. The other major category in foreign stocks is emerging markets. So before we looked at developed markets, now we're looking at emerging markets. So these are your Brazil, Russia, India, China. Typically considered more aggressive, more risky. So in order to take on that additional risk, we need to be rewarded with a higher expected rate of return. And over long periods, that has been the case, but over most recent periods, emerging markets really has not been a great place to be. And if you look at the chart, since we spent the most of last slide talking about currency impact versus emerging markets, the dollar, the currency exchange rate hasn't had as much of an impact as it did in developed investments. This slide, if you're interested in seeing how different countries did, you can press pause on the webinar, but there's really not a great story to tell here, and we don't invest based on any kind of predictions at all, let alone what's going on or what's expected in any given country. So not much to say in this slide. Now we'll get into something I touched on earlier in the presentation, and that is real estate investment trusts, also known as REITs. These are those vehicles where you can buy them on a stock exchange, and the underlying holdings are a professionally managed portfolio of commercial real estate investments. And these can be apartment buildings, they can be office buildings, healthcare facilities, they can be self-storage. There's a whole list of opportunities that are included in the REIT world, and the way Morris Financial Concepts and I believe in investing in this space is to be diversified across all those categories. So in our portfolios, we have a very small allocation to REITs. Within that allocation, it's very well diversified using professional managers. So if you look at the rate of return recently, you do see that here in the U.S., REITs had a really kind of a difficult second quarter. Globally, negative, but not quite so bad. REITs, because of the nature of what they invest in, are much more closely tied to expected changes in economic growth. So think about it that way. If the expectation is that economies will be growing, then people are going to be hiring. They're going to need more office space. So office buildings tend to perform well. In a contracting economy, people are laid off, leases are not renewed, office buildings don't do quite as well. So that's just one little example, but you can easily see why the fortunes of REITs are tied to fortunes of the economy. But in addition to that, in the second quarter, REITs suffered, as I alluded to earlier, because of the expectation that bond yields were going to be rising. This was when the Fed first started indicating that they would be starting to raise the Fed funds rate, and in turn, bond prices are expected to move in tandem. Now, REITs are impacted because a lot of people like to own them because they kick off a very substantial income stream. That's not why we hold them, but it is why quite a number of investors hold them. They're more risky than bonds. So the implication is, if people got into REITs because they were not satisfied with the yields that their bonds were providing, then if the expectation that bonds are going to be providing a higher yield in the future, they might not be needing to take the extra risk or wanting to take the extra risk in REITs. So those investors that moved from bonds to REITs may have started to tiptoe out of the strategy, putting downward pressure on their prices and resulting in this negative performance. Just like the country slide, we really don't invest in a targeted way in commodities. So I don't think we need to go into how the price of wheat changed in the second quarter. However, if you scan the top part of this page, you'll see that some of the best performing, or I should say the most increases in commodities prices, came from petroleum-based categories. Now remember too that this is coming off of an extremely low base starting in the middle of last year and coming into the beginning of this year. We remember that oil prices had dropped pretty dramatically, and therefore even a small change to the upside is coming off a smaller base and therefore a higher percentage. Now turning to bonds, and this is really the big story of the quarter. The chart, or the slide, is titled Fixed Income. That's simply another word for bonds. We're going to talk a lot about yield, so let's just define yield really quickly, and that is that when you talk about a bond's yield, you're not talking about its coupon payment. You're talking about the rate of return that you would earn if you buy it today and hold it to maturity. So you buy a bond today, if it's a 5% coupon bond, but you're paying a premium for that bond, your yield is not 5%. It's something less than that because you're paying more than par value. And again, give us a call or shoot an email if you need more elaboration on that. But again, in the second quarter, the Federal Reserve signaled at raising rates in the near future, and that would have a direct impact on this point in the graph right here, the very short-term end of the Treasury yield curve. That's because the Fed controls very short-term loans, and what this yield curve is showing you is that essentially if you buy a Treasury bond with a short maturity, that's not a lot of risk. There's not a lot of risk that the Treasury is going to default, and you're going to get your money back sooner because that short-term bond is going to mature a lot quicker. So you're not really taking a lot of risk. You're not getting a lot of return for taking that risk. So if the Fed starts signaling that they're going to raise the short-term rates, then this part of the curve will start creeping up. Well, what does that mean? That means that in order to take more risk by giving the Treasury, giving the government our money and buying bonds with longer maturities, we're going to require a higher rate of return than what the Fed funds is dictating for these short-term bonds. So a signal in the rise of the Fed funds rate triggers the beginning of a rise in yields across the yield curve. And that's exactly what you see here. You see this bottom line is what the yield curve looked like at the beginning of the second period, so the end of March. And then the next line above that shows you what the yield curve looked like at the end of the second period. And that's a pretty substantial jump. Now again, going back to the beginning, when I said when yields go up, prices go down, this is, in fact, the other side of that equation. We saw that bond prices went down, and this chart shows you that bond yields went up. This is a slide that looks the same quarter after quarter, but it really comes down to everything that we discuss in financial planning conversations. It's a reason why we assess investors' risk tolerance, and it also helps us decide what are the investors' goals and what's the minimum amount of risk that we need to take to get them there. Because what it shows you is that if you invest 100% stocks, then of course over the long term you're going to have a higher expected rate of return than if you invest in a combination of stocks and bonds, and certainly than if you just invest in Treasury bills. So the most conservative investor that says, I don't want to invest in stocks, if they did that 10 years ago, they buy a cash-like vehicle, they buy T-bills, and they get an annualized rate of return of 1.3%. Now, some people might be satisfied with that, but what you have to remember is that inflation over that period was something like 2.5%. So in general, just by holding Treasury bills, you've decreased your purchasing power by an average of about 1.25% a year because you're not willing to take on any additional risk. Now, as you start wanting to outpace inflation and maybe have a little bit of growth in your portfolio, you start moving back up this ladder a little bit and adding stocks into the portfolio. So you can see that even over this 10-year period where rates of return were muted, just by having a 25% allocation to stocks, which really isn't that much, probably not going to sink too many people's overall strategies as the stock market continues to be volatile, but 25% is a pretty conservative portfolio, but yet it still afforded you the opportunity to outperform inflation. And if you can stomach a little bit more risk, you obviously add incremental return, and these various portfolios are reflected in their return pattern in this chart on the bottom right. So you can see that the Treasury investor has a very smooth, very easygoing path to very low returns, but again, even the 25% stock investor outpaces inflation and doesn't really have too dramatic of an experience. Now, those that require a higher rate of return have a longer time horizon, and for whatever reason that's personal to them, they can stomach the ups and downs of the stock market, you do have these pretty substantial swings, but ultimately you are rewarded in the long run. So the last slide is something we talked about last quarter, and now would be a good time to pause your screen as well and read through this. I really think it is a great illustration of the value of an advisor. And most MFC clients, of course, all of those that are listening to this webinar understand that the value of the advisor is more than just what's my rate of return. I mean, if that's what it came down to, I think it would be very difficult for any advisor to say, I can guarantee you that I'm going to give you a rate of return that justifies my fee and is that much better than a passive investment opportunity. But what you're actually paying for is someone to be all of these roles that you see here. And I'll just let you run through it. I'm not going to go into every one in detail. But in general, it's for the hand-holding. It's for being there to help you make decisions and understand that when the stock market goes through rocky periods, that if you were on your own and the person at the barbecue told you it was time to get out of the market, maybe that would influence you. Maybe that would tell you get out of the market. But what your advisor is there for is to help you understand that this is just a part of being an investor, that there's nothing to be afraid of. This is normal. And if you look over the long run, these types of market environments happen all the time. And that's the risk that we take that compensates us in the form of higher expected return. If we undermine that by trying to time the market or overthink it, we really put ourselves at a disadvantage. So that's just one example how having that coach or that listener or that teacher be there for you is really the value of having an advisor. So that's the end of the presentation today. But as I said, please feel free to email your financial planner or any member of the ETF, of the MFC team, and if the question needs to come back to me, they'll be happy to forward it along, and I'll get you an answer promptly. Thanks, everybody, and have a great day.